Hey, Market Chameleons. Thanks for joining us for another pre-market Market Chameleon live show. How you doing this morning, Dima?
Good, Will. Good morning, everybody. Thanks for joining us. So today we're going to look at a couple different reports, and that's from some of the feedback. Yesterday, I was talking to two different customers, and I was reading some emails. So we'll look at a couple new reports that we don't usually do, and that's on a daily basis. We'll look at some of the benchmarks that we were talking about, option strategy benchmarks, and also get some option trade ideas from the screeners. So, but before we do that, let's get our disclaimer out of the way.
I'll get that up real quick. Let me just also say, if anyone's seen a fuzzy screen, I just sent out in YouTube Live, the stream, a link to our Zoom meeting. You can come there or make the adjustments to your settings. Also, thanks for joining us. Please subscribe to our channel. It's a big deal. And don't be afraid to give us a thumbs up. That's also a big deal on YouTube. And with that, D, I will go to the disclaimer.
Okay. So, and really quick, everyone, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help or professional advice, go seek out a registered investment advisor or call your broker. They should be able to help you answer those questions. There's a disclaimer, everyone. And I guess with that, let's jump to the pre-market screen.
What's going on?
Share my screen. So if you guys are joining us for the first time, this is the pre-market report. These are stocks that are trading in the pre-market hours. We got the most active stocks, biggest gainers, biggest decliners. Before we go to the top of the list with the biggest gainers, I just want to take a look at anything going on in the higher market cap stocks of 50 billion. So here we see at least these two stocks that made the top of the list. Intel, that's up 2.9% in the pre-market hours on 845,000 shares. Looks like some news out there. They're doing a buyback, I believe. Is that something you heard, Will?
Sounds right. Yeah.
GOLD, that's been on the news lately too. That's up 1.1%, and I think was that
Berkshire Hathaway taking a big position.
Right, Berkshire Hathaway. We talked about that they took a position in that stock. Actually, let's just take a look at Intel, and we're going to see what did Intel tend to do after a big gap up in the morning. How did the stock behave after the opening price? So I'm going to put on Intel here. As you can see here, close to 48.33, up now trading in pre-market 49.67, up 2.8% from yesterday's close. We see the pre-market VWAP, $50.05. Here's the chart in the pre-market hours, and I see the biggest VWAP bar between $50.16, $50.22 on 250,000 shares. Let's take a look at its gap up history. Now, this report, it's looking at the biggest gap moves to the upside in the last 3 years, biggest 12 gap moves to the upside in the last 3 years. It doesn't include the day of the earnings. So this just excludes the day of the earnings, because obviously this isn't an earnings move in Intel. So here we see these are the 12 biggest gap moves to the upside. These are the dates, any kind of notes, if the market went up or if there's some kind of news, you could hover over here. So we see the average of those gap moves is up 3.7%. That compares to today's 2.8%, so kind of close to that. What did it do after the open? So here we go. From the open to the high, the average move was 4.5%. That same day, from the open to the low, the average move was negative 1.5%. From the open to the close of the day, it tended to drift higher, more often than lower. 83% of the time, it continued higher. 17% from the opening price to the close, it was lower. The average return was 3.1% on the day. We see here's the volatility after gap move, up or down in either direction. It moved 3.7% historically, with a high move of 13.9%, which was right over here, 13.9% on May 13, 2020. Following coming out of this event, you see next day, then it tended to drift lower 75% of the time. The next day was lower for an average loss of 2.5%, kind of a mixed bag, then leading 2 days, 3 days, and so forth out. So that's quick price action analysis on Intel after it's seen a bigger move to the upside. And I think what is the market doing today? It's a little bit off. So here we see SPY down a little bit, negative 0.4%. And let me just close that out. So keep the news, take into consideration the news, what the rest of the market's doing, let you do all that analysis yourself. Let's come back to the big unfiltered report. We see OPGN, that's up 57% in the pre-market hours on 11.9 million shares. Small market cap stock. Looks like it's a healthcare stock. Some news related to the COVID-19. KZI, that's up 23.1% in the pre-market hours on 1.2 million shares. That's a very small cap stock, 6 million market cap. Also, I think that's a healthcare stock. There's some news on there. Let's just maybe grab this one really quick, OPGN, just to see that historical price action analysis on OPGN. We see here diagnostics and research. Down here, these are the news today. So you could take a look at that, make your own interpretation. We're just going to look at it from a price action perspective. So yesterday closed at 205. You see the 52-week range as low as 92 cents, $12.80, size $12.80. In the pre-market hours right now, trading $3.16. That's up 54.2% from yesterday's close. Here's the range in the pre-market today, 204, $3.42 on 12.2 million shares trading in the pre-market hours. That compares to a float of 19.7 million shares in OPGN. Biggest VWAP bar here. I see $2.95 to $3.06 on 3 million shares. So let's see, what did this stock do? Let's take a look at the biggest 12 gap moves in the last 3 years and what did this stock tend to do after the gap. So here we go. Gap history in the last 3 years, 12 largest gap moves. We see average of those 30.5%. That compares to today's 54%. And we've seen some here. Here's a 54%, 74% gap move, 60%. So really, it's no stranger to big moves to the upside, as we see today. After the opening, let's take a look at some statistics, what it tended to do. So from the opening price to the high of the day, average move was 22.5%. We see a couple times the opening move was the high of the day, drifted lower from there. The average move from the opening price to the low of the day, negative 18.2%. Very volatile. You see big percentage moves after the opening. From the opening price to the closing price, we see it drifted lower more often than higher. 67% of the time it was lower at the close from the opening price, 33% higher for an average loss of 4.1%. Leading out of this event, next day, 2 days, it seems like it drifted lower with on average negative returns. Let's just take a look at that volatility from the open to the close. We see in absolute terms 16.8% returns in either direction after. So a lot of volatility in this stock. High move 36.4% after the opening. So we see here up here, up 36.4%, gapped up August 7th, 11.8%, finished higher 36.4% from that opening price. So a lot of volatility in this small cap stock, just be aware of that. I could do one more or maybe move on and do you have questions on the pre-market? Anything coming up?
No, you hit Intel, which Hot Potato asked about.
Okay.
No pre-market questions.
Okay. So let's move on really quickly to, I'm going to try to hit on a couple earnings. Then we're going to go to, I'm going to try to hit on open interest, credit put spread ideas, and the benchmark. So I'll just keep going until you stop me, Will. These are earnings that are expected to come out in the next 2 weeks. We're going to look at from an options perspective. What are the options traders pricing that straddle and predicting the move in either direction compared to historical averages? So here we go. I'm going to filter out stocks that on average trade 10,000 option contracts per day. So let's just take a look up here. What we see is, what is the JYN? What's that? Okay, Nordstrom. So let's take a look at Nordstrom here. That's expecting August 25th. So that's actually what that's expecting August 25th right now. The straddle is implying a 17.4% move in either direction. That compares to a 4-quarter average move of 9.8% in either direction and a 12-quarter average move of 7.8% in either direction. The high move on that in the last 12 quarters was 15.9%. So you can see quite high compared to the historical averages, 7.7% above the 4-quarter average and 9.7% above that 12-quarter average. So it's richly priced in that straddle. Again, take a look. I know that a lot of these retail stores have been, popping a lot.
Well, it's really a tale of two retail stores, right? If you figured out your internet sales model, like Lowe's, I mean, they doubled doubled their internet sales quarter over quarter.
Yeah.
But,
So for
some retailers haven't even opened up. They're still
yeah, it depends on your model. Like if you have a good e-commerce internet website, those have been doing really well. It's been kind of like a boom, especially with like people staying home. They're going on the internet, doing a lot of shopping over the internet, and we've seen that. Also, I mean, what else we've seen, like Target, Home Depot doing really well as well. So I thought I saw something coming up tomorrow. Let me just see, let me just loosen that up. Okay, so you mentioned something this morning, DE, right?
Yeah, someone was asking about Deere. Yep.
Okay, so Deere, that's coming up tomorrow before the market opens. Right now, as of yesterday's close, that straddle was priced for a move of 4.1% up or down in either direction. That compares to a 4-quarter average move of 4.2% and a 12-quarter average move of 4%. So basically, like right there on those historical averages, we see a high move in the last 12 quarters of 7.7% in DE. So I know that you said that symbol came up, so it was worth just mentioning that.
Yep.
Let's move on to the open interest really quick, and then I'm going to get some benchmarks and just stop me if there was a question, Will.
Excellent.
All right. Open interest. Let's take a look at from yesterday. Let's take a look at some long buildups and call options. So here I'm going to use the filters here, and one of the things I'm going to look for is that the open interest on any one contract had to change by at least 1,000 contracts or more. And we're going to say that on a relative basis, that open interest had to be at least 20% of the stock's average daily option volume. So at least 20% or more of the stock's average daily volume. Let's filter out option type. I'm going to just look for the calls at this time. Let's take a look at the option price. So the option price has to be at least 25 cents. So we're not looking at very low price, like penny or 2 penny priced options. The option price yesterday, let's say, had to change by at least 10 cents or more. And the volatility on the option, let's say that the relative premium was higher, so the implied volatility in that option was higher, at least 10% or more. Let's see how many we filtered out here. All right, so there's like 16 of them right now that made the list. Let's take a look at maybe stock price. Let's do above 25. All right, so we filtered it out down to 5 of them. So INOV, we see that stock $25.27. Yesterday, the August 21 calls, so these are in the money calls. They finished at $8.40. The implied volatility on it was up 45%, but we see that the open interest on that actually decreased on the day. So that looked like it was a short covering situation because open interest was decreasing as implied volatility was going up. So the assumption is that people were buying those back who were short. NAV, that stock was up 3% yesterday, finished at $33. Looks like the September 18th, 34 calls out of the money calls by dollar. Those were up $1.53 yesterday on the day to $2.33. Implied volatility was up 83% in that option. Looks like open interest increased by 2,156 contracts on that line. That compares to average daily volume of 645 contracts in total. That's why we're getting that long buildup indicator. RPAY, that stock was up 7.5% yesterday. Looks like that front month expiration, the 25 call that are in the money by 81 cents now, that was up 90 cents to $1. That also looks like it's a short covering situation. Open interest decreased by 50%. The assumption is people who were short were buying that back. Yeti, YETI, up 2% yesterday on the day. We're looking at the money call, August 21st was open interest increase, and also the September 18th expiration 52.5 call. Both open interest increased 1,327 on the August 50 call and the August 21st expiration. On the September 18th expiration 52.5 call, a little bit out of the money. The open interest increased by 2,029. We see here both situations, the call option increased in price, implied volatility increased 20.7% in the August expiration, 10.3% in the September expiration. So really quickly, just wanted to go over a few of those as an example. If you don't have any questions in the open interest, let's go do. Yep.
Jake was asking if you ever use that Yeti product at the beach.
What is? Oh, Yeti, you know what? I've seen. Yeti, yeah, so I go to the beach. He knows I go to the beach. So I've seen. I do have friends who have the Yeti. And have you used it? The coolers? I've seen people.
Yeah. No, I think
I haven't claimed. Huh?
My wife bought me one for my birthday. I think my birthday is right at the beginning of the summer, right around Memorial.
Okay. And is it worth it? I've never used it, but I've seen.
They're so expensive. I was like, did you really? Yeah. You know, it's hard for me even to use. I know what she paid for it, but it is a really good cooler. But yeah, give me a Coleman any day of the week from Walmart or something. I do not.
Yeah,
that's what they sell. They sell super high-end coolers and a lot of swag around it, t-shirts, hats. But there's a community that love that Yeti product.
Yeah, I think this weekend I'll ask if when I see people with them, I'll ask them if they are happy with that Yeti.
By the way, Jake just jumped in to the chat and he says jobless claims rise over 1 million.
Okay.
So, yeah.
So that number just came out today.
Yeah. That's what Jake says.
So thank you, Jake. So we'll see how the market reacts to that. But let's just move on then. If there's nothing specific about open interest or this report, let's take a look at some benchmarks and how to use some of these benchmark tools that people have got. So I'm going to use SPY here. And when you're looking at the SPY, here's some strategy benchmarks. It's very hard. Here, we'll start from the beginning. When you're looking at SPY and you're looking at the options chain, of course, you have a lot of choice to structure a different strategy. You're faced with, well, what kind of strategies should I do? And based on your outlook, and you're looking at all these prices, and you could do a straddle, a strangle, a risk reversal, credit spread, a debit spread, a butterfly. So all these different strategies with different outlooks. The problem is then you got to structure them, analyze them one by one. It's very time consuming. So that's where the benchmarks make that easier for you and faster. So let's take a look at an example here. And if, for example, I'm looking at SPY and just want to analyze it from perspective of volatility movement in either direction, I could just go here to the straddle benchmarks. So here, this is as of yesterday's close. I see that for a 30-day straddle, 30-day constant maturity, right now that straddle, it would cost me 3.9% in premium. So it'd have to move by 3.9%, or for me to break even more than that if I'm buying it, less than that if I'm selling it. 3.9% would be the cost. That compares to a 52-week average of 4.9%. So on a relative basis, from a historical perspective, I see that there's a 1%, it's 1% below that average. So that gives me a really quick reference, depending on what I want to do. From that perspective, I could go out a little bit further and let's say, hey, let me see if I could buy something cheaper going a little bit further out, maybe to cover some type of event that I think there'll be some volatility, like for example, like election or whatever events you think are coming out there that might be a market moving event. So here from the 30-day, I could go to the 60-day. So these are options that have 60 trading days to expiration. So we see here, they're also a little bit here priced lower, 6.1% is the premium on them versus a 52-week average of 6.9%. That's a 0.8% difference, cheaper than that average. 90-day going out, we see that's right in line, 8.5%. That's the current straddle premium versus 52-week average of 8.5%. So that's right at that 52-week average. As you go out a little bit further, that looks like right now 120 days, trading days to go. That premium is 10.2%. So that will cost you more than that 52-week average of 9.9%. Let's say you wanted to do a strangle, basically, instead of saying I don't want to buy that expensive at the money straddle, buying the call and the put at the money, but I think it's going to have a really big move. I'd rather buy the wings, right? So these are 5% out of the money calls, 5% out of the money puts. On a 30-day maturity, we see those also priced lower than the average. Right now, it costs you 1.1% in premium versus that 52-week average of 1.8%. This is what a chart would look like in a strangle at expiration. So you see it has to make a big move outside those strikes for you to start making money. Anywhere in between, you would lose that premium. Going down, let's take a look at the 60 trading days to maturity, and also 5% out of the money in each direction. That will cost you 2.6% versus a historical 52-week average of 3.3%. 90 days out, that looks like closer to the 52-week average, 4.5% versus 4.6%. Again, some people like to sell them, some people like to buy them. It just depends on your outlook. If you think that the market's going to sit there and it's not going to move anywhere, then you would be looking to sell premium. If you think it's going to move a lot, you'd be looking to buy it. So if you're selling it, this chart, it would be flipped, right? You would be profiting if it landed anywhere between those strikes, and losing if it went outside. Let's take a look at the 120 days. So these are the long dated options. That looks like it would cost you 6% to get the 5% out of the money wings versus a 52-week average of 5.8%. So that really quickly, before even going into the options chain, you have those benchmarks should I go to the options chain and look at other strikes, but you have like benchmarks right there to get a general sense how high or low those premiums are priced versus 52-week average premiums. Let's take a look at another one. Here's a ratio call spread. So ratio call spread would look like this. So if you're looking for big upside move, you know, but you think that potentially you can just go down or kind of sit the same. So that's when you're selling an at the money call, buying 2 out of the money calls. So if it breaks through to the upside, that second call will start being profitable. Here, right now, you'd receive a credit of 1.5% versus a 52-week average credit of negative 1.2%. So you're getting a little bit more than that 52-week average. Again, that's, you would receive a credit for selling 1 at the money call, buying two out of the money calls that are 5% out on a 30-day maturity. So over here in this gray, it would be profitable. Let's take a look at something that's 60 days out, ratio spread. Right now, you get a credit of 1.4% as of yesterday's close versus 52-week average credit of negative 1%. So there you would be receiving more premium than the historical average. On a 90-day maturity, negative 0.8% credit versus 52-week average of negative 0.6%. And the very long dated ones still getting a credit, negative 0.2% versus a 52-week average of negative 0.1%. So if you're looking to do this type of strategy really quickly, you could go through and see how those benchmarks are lining up. And you have all these different strategies depending on your outlook, you know, what you want to do. You got diagonals here, calendar spreads, iron butterflies, let's take a look at an iron condor. So iron condor here, you're selling out of the money call spread, out of the money put spread, right? So what you're trying to do is say the stock's not going to move a lot between these benchmarks over here. So here, the 2%, 5% out of the money call spread, 2%, 5% out of the money put spread, credit right now negative 1.2% versus a 52-week average of negative 1.4%. So a little bit lower than that historical 52-week average. This is what the graph would look like at expiration. Coming out 60 days, right in line, negative 1.8% versus 52-week average, negative 1.8%. 90 days out, negative 2.2% credit versus 2.1% average. And 120 days, right in line, get a credit of 2.3% versus a 52-week average of 2.3%. So that's really quickly the benchmarks, how you could just take a look at, maybe you have a strategy in mind or what the market may do. And you could kind of see from a historical perspective, you could get long, short delta, neutral, short volatility, long volatility, but you have these benchmarks in front of you to make a very quick decision. Let's go to the other question I had yesterday was showed some examples of credit put spreads. These are credit put spreads. This is the screener here. People use these, you know, to get some bullish ideas in options trades. I'm just going to go to one of our preset ones, and I'm going to look at market leaders with positive theoretical edge. So this is as of yesterday's close. Let's take a look at this preset screen, and right here we see an Apple. Right now, this one is looking for positive edge trade in and Apple is considered a market leader right now in that S&P 500. So we see Apple closed 463.15. It's looking at the September 18th, selling the 460 put, buying the 455 put. That credit is $2.15 as of yesterday's close. We think it's worth $1.22 based on historical data and stock behavior. That gives it a 32.6% theoretical edge because you're selling it above that theoretical value. and a historical win rate or probability of profit of 74.5%. So that looks like if the stock just sits there, so if Apple just sits above 460 or goes higher, sits at this price, stays above 460, goes higher from this price, that's a return of 75.4% on the money at risk, right? So you're doing a $5 put spread. If you're selling it for $2.15 and you got to buy back for $5, if it's below here, you're risking $2.85. So as long as it stays above 460, that's a 75.4% return at September 18th expiration. So a little bit less than a month to go. Microsoft right now showing September 18th expiration, selling the 210 put, buying a 205 put, $1.90 credit. We think it's worth $1.15 based on the historical data. That gives it a theoretical edge of 24.3% with a historical win rate or probability of profit of 76.1%. If the stock kind of just sits right above that 210 or goes higher, that's a 60% return on money at risk. Facebook, also looking at September 18th, 260 put, selling the 260 put, buying the 255 put for $1.85 credit. That's where that closed as of yesterday. We think theoretically it's worth 92 cents based on the historical stock behavior. That gives it a theoretical edge of 29.4% with a historical probability of profit of 80.9%. And if that stock stays above 260, that's a 58.7% return on money at risk. Let's do the next one, Walmart, and then I'm going to do a different screen on here. So Walmart, that closed 132.36. This is looking at the August 28th expiration. So that's that's next week, right? Selling the 132 put, buying the 128 put. Right now you get a credit of $1.22. As of yesterday's close, we think it's worth 71 cents based on historical data. That's an 18.3% theoretical edge with a historical win rate of 76.9%. That if that stock stays above 132, goes higher, that's a 43.9% return on your money at risk. Let's do
while you're there, we did have a question about TGT, which I think's down on that list. Could you just look at that real quick?
TGT.
Yeah.
Okay, TGT target. They're looking at just for the credit put spread.
Yeah, they were just asking about it earlier, so it's something that popped up on your screener, so you might as well take a look at it.
Right, and they just reported earnings August 19th yesterday. So here's TGT. That's looking at the stocks 154.21. It's looking at the August 21st 155. Some 155 put, buying the 150 put for $1.95 credit. We think that's worth $1.26 theoretically based on historical data. Gives you a theoretical edge of 22.5% with a historical win rate of 73.1%. If that stock stays here, goes higher, that's a 38% return on your money at risk over here. So I'm going to do one more screen. So these are all presets here. Let's take a look at, and a lot of people like to have a downside cushion in case the market goes, so they're willing to, have less return, but more cushion if the market reverses. So let's do best by downside cushion. So these are still looking for positive theoretical edge trades. It's looking so it's scanning the market looking for, well, where do I get positive theoretical edge, good historical probability of profit, but I also get a cushion in case the market goes down. So some cushion. So here in Apple, we're looking at Apple, $463.15. So September 18th expiration, selling the 430 put, buying the 425 put. For right now, you get a credit of 85 cents. We think it's worth 32 cents. That gives you a theoretical edge of 12.8%. with a historical win rate of 93.6%. So that's a return of 20.5% if the stock just stays above 430 by September 18th, but you get a cushion 7.3%. In other words, even if, if the Apple stays here or goes higher, you're making money. If it reverses, you have 7.3% until you hit your break-even point. See the stock 463. As long as it stays above 430, you keep that credit. If it falls below 430 by 85 cents, that's your break-even. Below that, that's where you start losing. Microsoft now 209.96, almost 210. Looking at the September 18th expiration, selling the 195 put, buying the 190 put for a credit of 62 cents. As of yesterday's close, we think it's worth 15 cents, theoretically, based on historical data. That gives it a 10.7% edge with a historical win rate of 93.5%. If the stock stays above 195, September 18th expiration, that's a 14.2% return on money at risk. But again, you get that big cushion of 7.4%. So that's goes down 7.4%. That's your break even. Below that, you start losing. Facebook, let's take a look at that. 262.85, selling the September 18th 240 put, buying the 235 put. Right now, it's a credit of 58 cents. We think theoretically it's worth 13 cents. That gives you a 10.1% credit with a historical win rate of 95.7%. If the stock stays above 240 September 18th expiration, that's a 13% return on money at risk. But here you get even a bigger cushion than these two, an 8.9% cushion until you hit your break even. Let me take a look. TSM, that's Taiwan Semi.
Yep, you got about 2 minutes, buddy, before Jake's.
Okay. Do you want me to wrap it up then?
You can do Taiwan Semiconductor real quick.
Taiwan Semi over here. That's September 18th. It's selling 75 put, buying a 70 put, credit of $1.05. We think it's worth 57 cents. That's a 12.2% theoretical edge with a historical win rate of 83.3%. You get a 5.8% cushion to the downside, and your return on the money at risk is 26.6% as long as it stays above 75 at expiration. So really quickly, try to get in.
Awesome job, D. That was quite a morning show. I can barely breathe. We learned so much today.
Well, thanks everyone for joining us. Hope to see you guys tomorrow. Thank you for the questions and the suggestions, and have a great trading day.
Great. Have a great trading day, everyone. Remember to like us and give us a follow on YouTube. That is a subscribe, actually. Thanks, Jake, for that heads up. All right, everyone. Have a great, safe trading day. Bye, D.
Bye. Bye, guys.